What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is June 30th of 2018. Well, folks, it's time for a daily update here on the DataDash channel, and today we've got a wide range of topics to discuss here on the update. First and foremost, as always, though, we're going to be spending a good amount of time taking a look at market valuations, as well as doing some technical analysis on the market leaders. But outside of this as well, we've got some key headlines both in crypto and traditional markets. First up in crypto, we have a news piece that has gotten little to no coverage and is still under the radar. It's a new ETF model that was recently released by the SEC that's going to be voted on in about 60 days, where we could see emerging ETF concepts like a Bitcoin ETF come to market much faster. Along with this as well, there's been rumors that the tech giant Facebook is looking to acquire Coinbase. We'll look at the validity of these rumors later on in the video. And last but not least, we're going to be talking about the financial sector in general, some of the warning signs we're seeing, and along with that as well, Deutsche Bank being one of the leading indicators in the market of a recent failure for the stress test for the Federal Reserve. So we've got lots of different things to talk about. Let's not push it off any longer and dive right into the update. So I'm happy to say this, everyone. Finally, after weeks of just sad price action in crypto markets, we finally have something positive to talk about. Finally, after weeks and weeks of sell-off and red price action, we have green movement across the board, with a lot of players actually that we all probably know, Power Ledger and 10x, leading the market in the top 100. In fact, they jumped all the way from the lower 200s all the way up to this range towards the high. So you can see across the board, though, they're not the only ones. The entire market is looking green at the moment outside of a few players, and this is definitely something nice to see after all of the sell-side action. So it's a breath of fresh air. But the question we have to ask ourselves is whether or not Bitcoin can hold, and if altcoins will follow, and if we're holding at key levels of support in this market that we need to hold. So let's take a look at that as we go throughout the video. So as we take a look here at market valuation, what is really nice to see is that whereas we were starting to look like we were going to dip below towards $200 billion, we've generally held around the big even of $250 billion in market valuation, which again is at a pretty nice discount comparative to where we were back in January. We were sitting at $824 billion, almost $1 trillion valuation in crypto, now at much less than where we were beforehand, pretty much $250 billion, around $250 billion. So hopefully we can hold that. I'm going to generally be looking for that, but along with that as well, I'm going to be watching Bitcoin market dominance. We can see here that we've had a slight dip over the past day due to the fact that we obviously had a nice rebound and altcoins followed up even faster than Bitcoin. And I don't think you're going to be seeing Bitcoin dominance come back up to the highs here, guys. Again, over time, you're going to have periods where Bitcoin dominance can rise up. It can get, regain a sense of valuation or holdings of valuation over the entire market. But again, as we take a look over the long term, we see that consistently Bitcoin's market dominance continues to decrease. It's taken a second here to load the data. I guess it's just a lot of price action. There we go. But we can see here that there are periods of rebounds, but generally every time we make new lows in the sense of market dominance. So that's what I'm looking for here. I'm looking for market dominance to continue depleting for Bitcoin, at least in the short term. And I'm going to be talking about how we can potentially see altcoins do quite well as we go into a short-term rally. Now, as you all probably know, we talked in my last video, my last daily update, what my mindset's generally on right now is that we are holding the triple bottom. Yesterday really confirmed that, and we'll dive into the price action in just a second. But I think that, if anything, we might have one more resistance point here at 8,000, and then another test here for the fourth time, and then a climb through the descending triangle, which, again, to be fair here, is technically seen as a bearish pattern. But we've seen in the past that the exact same price action has happened in the last correction back in 2013, where we held at 400 multiple times and finally had a breakout through the triangle. So I think we're going to see something similar to that, especially if we get talks again about a few other catalysts such as Ethereum futures contracts or potentially the Bitcoin ETF we were talking about. If we get that, I think this market is going to go absolutely haywire. But we can see here generally in the short term that we've had a bounce off the RSI. We've had a nice jump of price action over the past 24 to 48 hours. We can see here that we got some nice leaps up here, multi-$1,000 Bitcoin buy candles on the hourly. Not as much as what we saw back in April when we got the first initial rebound and then the continuation of the uptrend. At the moment, we've had two serious buy areas where people came in below 6,000 for the first initial one, and then we got a secondary rebound. So it's nice to see this. It's nice to see some actual volume, but at the same time, again, we're seeing markets being moved by these big volume candles, and then afterwards it's just pushing sideways, generally what is referred to as the BART trend in a sense. So many people are worried that this could falter over, that this could simply be the fact that a lot of margin traders were squeezed out of their trades, short squeezed, in the sense that they were shorting with leverage on Bitcoin, and a big buyer came in, and that was a lot of the price reaction was just people getting out of their positions and covering their rear ends, for a better use of words. But I think right here is generally where you're going to stop seeing sell side action, everyone. I think we have an opportunity to hold support at these higher levels. So over the next few hours, I wouldn't be surprised if you get another big buy candle. There are a lot of shorts getting liquidated yesterday, and a lot of people are being cautious in this market, especially as we were able to exit out of outside of the lows below 6,000 2 times. It shows that there's a lot of buy side pressure, both from miners, both from traders, and I can tell you guys on the OTC side of things, from what I'm hearing, people are buying in droves in that sense. That's as simple as I can keep it in that sense. So in this sense, I think price action is at its lows. We've got the triple bottom. A lot of people got faked out because we went below 6,000. And at least in the short term, we are going to see a good few weeks worth of upside price action. But we need continued volume, and we need to make sure that we can hold above 6,300. We don't want to see this really dipping below that throughout the next few hours. We want to have a nice full green candle where the wicks isn't making this look exhausted and roll back over. So going on here, let's go ahead and talk about the news here. Generally for TA on altcoins, guys, again, not too much to cover at the moment. We'll get back into it if things keep trucking along and we get back into the cycle. There's a lot of good players, but I want to talk more about this fundamental news here about the SEC proposing a new way for people to bring ETFs to markets. So this is not something that's been passed. It's not something that's confirmed. This is something that's going to be voted on, I think, about 60 days. If we go down here to the bottom, it's going to be yeah, the different amendments are going to be generally discussed and, I guess, voted on in a sense in the next 60 days. But as I was reading through this, there's a little bit of technical jargon. It's a little bit complex for an average person to read. I'm, generally average when it comes to this kind of technical talk. I understand a decent amount of what the proposal is talking about, so I can explain it. But generally speaking, the SEC has realized, it's not specifically tailored towards crypto, but they've realized that the ETF market, the exchange traded fund market, has grown immensely over the past few years. Passive investing has become a massive trend in the United States, where basically you can download apps, whether it be apps that help build a portfolio for you or something as simple as Robinhood, and people just buy ETFs in sectors that they think are going to do well. So they might buy a tech ETF where they get a big mix of companies like Google and Amazon and Netflix and emerging biotech companies all in one ETF. Or they might get one for the financial sector. Maybe they believe banks are going to do well and they don't want to pick one bank, or have to go out and handpick banks. ETFs can be very convenient, and they can also help people trade commodities and trade at different variables using leverage in a sense. There can be leveraged ETFs. But basically, the SEC has set a few preliminary measures where they want to build a new framework, whereas it excludes a lot of ridiculous ETFs. So it does exclude leveraged ETFs and a few other ETFs that meet certain standards in regards to funds that manage them. But for the most part, it is going to allow the floodgates for a lot of new ETFs to be explored, so long as they meet a certain set of requirements and rules without having to get SEC permission in a sense. Now, the SEC, again, could always step in. It could always stop something if they feel there's something wrong. However, they're going to set a preliminary framework that helps kind of expedite the process. A good way to kind of picture this is in the United States with the FDA and drug approval. Drug approval in the United States is pretty complex. It's very time consuming. You could have a drug that could, excuse me, I bumped my mic there. You could have a drug that has cured a disease. It has absolute proof in early stage tests, but you've got to go through all of the trials, and it can take years and cost millions of dollars to do it. And the same goes with financial products through the SEC sometimes. It can take very long to do that. I can give you an example. The gold ETF, GLD, took a lot of time for SPDR to put it or for Spider to put it into the market. And that was a big revolutionary financial product for a lot of people. It gave them the opportunity to invest in gold. Anyways, I'm rambling on here. Fact of the matter is, though, is that if you can have this preliminary framework come together in the next 60 days, be broadcasted out to financial companies, and if it allows the opportunity to build ETF or financial products around cryptocurrencies, we could very well see not only a Bitcoin ETF, we could see a wide expansion of cryptocurrency ETFs. We could see not only Ethereum futures contracts, we could see Ether ETFs in this case. We could see a top 5 cryptocurrency ETF. We could see a protocol ETF. I mean, it would really open the floodgates for a lot of financial products and financial investment into this space, which could lead towards a serious run-up. Now, again, I tried to read through it as best as I can. If you guys go through the document and you find something that says this would exclude cryptocurrencies, let me know. I didn't see anything in there. Really, the only framework they had a few standards that they had set. You know, there was I'll see if I can find it here, but it was very, very minuscule ones, things that didn't really have to do with specific classes of assets. It was more how how it's managed, and along with that as well, if there's leverage involved, and they didn't want to obviously expedite the process of leveraged ETFs because those can be quite risky and come with some unseen consequences for new investors. So, guys, definitely recommend you look through this if you want to see you know, all the details about it. I put it in the description for you guys. I also shared it on Twitter if you guys want the link. But along with this as well, I want to spend some time to talk about the headline that has been circulating around about Facebook's flip on cryptocurrency ads. Many people have been talking about the fact that Facebook has revoked the ban on cryptocurrency ads, much like how Google had done back a few months ago. And there's a reason behind it in the sense that they want to supposedly acquire Coinbase. I'm going to be honest with you guys, as much as that would be pretty cool to see such a large tech giant come into the crypto space and get excited about it. You know, I could see how that would, you know, get people excited in the sense that it would bring traction. And if Facebook, for example, some people rumored as well that Facebook's going to create its own cryptocurrency for remittance payments. You know, I wouldn't doubt that we could possibly see these things, but at the moment, I'm going to let you all know it's all smoke and mirrors. There's no actual evidence. In fact, this rumor's been stemming around from an article back on The Economist where there's literally a one-sentence quote that said, "There are rumors Facebook wants to buy Coinbase, a cryptocurrency firm." Okay, and this is the kind of stuff that you get in the mainstream media all the time. I'm breaking it down for you guys right now because I deal with this on a daily doing my research. I've stumbled once and twice before in the past talking about something, and then I realized that it was all rumors and speculation, continually being cited to an original article that has no basis on the statement. So in this case, I wouldn't be too eager to say that, you know, Coinbase is looking to get acquired at this level. Not to mention, even if Facebook wanted to offer them something, you know, Facebook has tried to acquire things in the past. It tried to acquire something as simple as Snapchat and offered billions of dollars and got rejected. You know, that's the kind of stuff that happens sometimes. It's whether or not Coinbase wants to allow itself to get acquired when it has such a leverage on this space. So I wouldn't be surprised if you see Facebook creating its own cryptocurrency. I think that's going to be a very interesting thing for a lot of companies to try and do. You know, there's really not much negative, you know, feedback that could come, or I guess in a sense, negative consequences for doing a properly run securitized ICO if they're going to be building some type of, you know, ICO, or they're going to do a currency of some sort, you know, whatever it is. That being realized, no evidence so far. Good to see that they're rolling back the ban on cryptocurrency ads, though. I like that. Good first step. Going on to our third talking piece here, I want to talk about the weak point in traditional markets at the moment. This is something that I'm going to be emphasizing a lot over the next few daily updates when we talk, because this is something that I've been watching for the past few weeks, and that is the stance of the financial sector in current traditional markets. The number one key indicator we had to know that the economy was setting for a recession back in 2007 and 2008 was all throughout 2007, where the financial sector was remaining stagnant. We have a good chart down here where we can see this. You know, there was a lot of people who were, you know, living it up, partying, you know, enjoying the bull run back in 2006 and 2007, all the craziness that was going on in the housing market. But a lot of people were focused on the financials, and they saw that it was peaking at previous highs of 2000 and was showing stagnant price action. It's generally not so much accumulating, generally having a top multiple times, not being able to break to new highs, and from there we saw that the dominoes eventually fell when Lehman Brothers collapsed, and you started to have the entire set of catalysts come into the equation. The fundamentals were bad, they are still today, but it's a question of when you can get the first domino to fall. So I not only recommend that you keep an eye on the financial sector, look at a lot of the major indexes for the financial sector, and you'll see the exact same things. But interestingly enough, along with this, not only is the general financial sector down, we also have a very interesting headline in relation to one of the catalysts we've been talking about. I've been talking about Deutsche Bank, its high exposure to derivatives, the continued worries that Deutsche Bank has had, its share price is down below 2008 levels. Deutsche Bank recently failed the Fed stress test. Now, for those of you who don't know what this is, stress test is generally something that the Federal Reserve runs from time to time on commercial banks in the United States, and they go through an evaluation process to see how these companies would respond or be able to respond in specific scenarios of financial crisis or financial constraining, meaning that we're in a tight economic situation. If we were to set higher interest rates, cut quantitative easing, and maybe we stop seeing GDP growth as much as we're seeing now, what would the bank be able to do? Well, they found that they had some generally along the lines issues in regards to their capabilities of being able to have capital planning process. This is a very fancy term for pretty much long-term evaluation of how you're going to be spending your capital. So like, you know, if the economy goes bad next week, what do we do in the sense to maintain our business model and stay sound financially as a bank? And what are we looking forward to if things go wrong? You know, what can we do in that kind of environment? And along with that as well, having the models for assumption on what they're going to be earning revenue-wise and income-wise in regards to a stressed environment. So the models they use in the sense of measuring how much they're going to make in times of struggling. So in this sense, you can generally see the Fed, just like any other commercial bank regulator in a sense, a lot of the financial regulators, even though they are run by commercial banks, the Federal Reserve and central banks are owned by share in commercial banks. We don't know who exactly owns it, but we know that generally the Federal Reserve and central banks, to put it in simple terms, their main objective is not only to manage monetary policy, but they have to keep an eye on one another. Banks don't trust one another very much. They understand the secrets that keep them in power and keep them very wealthy in a sense by creating debt out of thin air, but they don't trust one another. And they haven't been lending to one another for quite some time. The environment has gotten very competitive. And because of this, they have to look at for warning signs, because if one of the players in the space, just like how Lehman Brothers got reckless back in the mid-2000s, if you have Deutsche Bank, the US branch here that the stress test went under, if it can't sustain itself, then this is a very worrying sign. And generally, Deutsche Bank, even if it's in the Eurozone and not in the US, it's still a concern. So with the crazy amount of layoffs, I think the 8 to 10% of the workforce at Deutsche Bank that got laid off is not helping. If that's not helping and they're still having issues with capital planning process, in the sense of long-term thinking and being able to survive in a stressful environment, the fact that the Fed is saying this and has set new rules and regulations on 3 other commercial banks in the United States, this is a pretty interesting sign, and it's something that you tend to see at the end of a credit cycle where interest rates are rising and quantitative easing is drying up. Not to mention as well, the Fed is emptying off its balance sheet. It's starting to get rid of the mortgage-backed securities. It's starting to sell it out to market. The pace of that is going to pick up over time. They're going to get rid of U.S. Treasuries. I mean, they are basketing off a lot of things that people would pray in the stock market that the Fed continues to hold. But eventually, you've got to get rid of those items, and eventually the dominoes will fall. The question is, what's going to be first? Let me know down in the comments down below if you guys have an idea of what that's going to be. If you guys have anything to say about all the topics we talked about today, leave it down in the comments down below as well. Until the next video, everyone, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.